Good evening, everyone. Welcome to our webinar titled Tax Planning Strategy in 2022, which is part of our Many Matters series here at the Champaign Public Library. I'm Eva Liu, a reference librarian at the library. Thank you for joining us. We are currently fully open to the public with regular hours. If you are not comfortable coming into the building, we are operating our phone, virtual reference service, as well as curbside pickup for any items you would like to check out. For more details on this and all of the latest library news and updates, please visit our library website at champaign.org. Or you can follow us on social media, chat with us, or email us. Finally, I would like to introduce our presenter for the evening, Tyler Wrezinski. He is the president of the non-for-profit Institute for Financial Education. Tyler is passionate about helping people plan for the effects of taxations and inflation on their lives savings. Throughout his career, he has been helping families plan for worry-free retirement. We are so grateful that he has come tonight to share his expertise with us. So Tyler, thank you for being with us. And with that, I will turn this over to you.
Thank you, Eva, for that very nice introduction. I appreciate it. And I'm glad to be here and be spending this time with you folks talking about important subjects. Tax planning certainly is one of them, and something that's at the forefront of people's mind. And so we're going to spend some time tonight just talking about what's relevant currently. And I will start off by saying that there's a lot of balls in the air with what tax planning is going to look like going forward here in the next few years. So we have to deal with the information that we know. And we know a few things. We know the government has spent a tremendous amount of money in the last couple of years on COVID relief, and they're going to have to get that from somewhere. That will be coming from taxation. We also know that even prior to COVID, the government's plan since 2017 was to revert to the 2017 tax levels at some point in the future. And we'll talk about that a little bit tonight as well. So just to let you folks know, one of the reasons that I started the Foundation for the Institute for Financial Education, and I co-founded it with a CPA associate of mine, was because we really believed that the financial service industry had been doing a disservice to people and just teaching them how to buy financial products without ever really telling them teaching them how to think about their money and their financial life. And what we realized was that people deserve better. They deserved more. And they deserved a better result from their financial plans, from the hard work they put in, and from their advisors and the companies that they work with. And we wanted to find a way where people could get education, learn about these topics, and not be sold something by some type of financial advisor. So we wanted to give back to the community to do that. So we're going to jump in tonight here and just talk about a variety of issues, but we're going to talk specifically about taxes. So I'm going to go ahead and share my screen here. All right. And just let me just get the slideshow started here. And we'll just talk a little bit about taxes and the IRS and tax planning strategies here for 2022. And today I really want to talk at a high level. We're going to discuss the things that are most common to people, all right, and that most people will be able to reflect on, or that will be impacting their lives at the most common level. So people may have, unique tax questions or something going on. We can absolutely help answer some of those questions if people do ask them. But we're painting with a broad brush tonight. So let's go ahead and jump in here. I'm going to give out my contact information as time goes. As part of this process, we always try to give people the opportunity to ask us questions via email, or even if they want to get together and chat for 20 minutes or half an hour on the phone, we try to give people the time to be able to do that. So I'll give out my contact information later, and if folks want to do that and have additional questions, it's our goal to try and get them pointed through to some resources in the community that can help them answer those questions. All right, so this is a big long disclaimer. I have to put this up because in my day job, and my other hat that I wear, I do help people create comprehensive financial plans. That's not who I am. Who I am is somebody who's passionate about making sure people have education in their life so that they can understand that they're going to be okay no matter what. All right, so this is just a big disclosure here that I have to share with folks. All right, so when it comes to tax planning, there's basically three approaches that people take. The first approach is they just get TurboTax, right? And they go out and they say, hey, I'm going to get TurboTax or some other Quicken tax or something like that. And I'm going to plug my information myself and just pay the IRS whatever the program tells me to do. All right, so this is really not tax planning. It's actually just tax preparation and tax reporting. It's paying our taxes. It's not proactive. It's very, very reactive. It's on the reactionary side of the scale when it comes to tax planning. And this is what the vast majority of people do. Either that or they have a tax preparer. And a tax preparer isn't necessarily a CPA or an accountant or somebody who's even really an expert when it comes to taxes. Generally speaking, what a tax preparer does is they help people compile their tax documents, compile that data, and then pay the IRS the appropriate amount of money. Now, oftentimes I hear people say, oh, I get tax advice from my CPA or my tax preparer, whoever that might be. And what's really happening to that person is they go in and their tax preparer, their CPA, or their H&R Blocker guy, or whoever it says, here's your tax return, or you could pay a little less in taxes if you put more in your 401k or IRA. And that's kind of the most tax advice anybody ever gets. Hey, max out your 401k or IRA. And it'll lower your taxes on a year-to-year basis. Once again, a very reactionary way to do things. Oh man, my taxes are too high. What if I put money into a 401k or IRA? Big questions on that, right? Can you quantify with absolute certainty that putting money into a 401k or an IRA is going to keep your taxes as low as possible over the course of your lifetime? I'll say that one more time. Have you quantified with absolute certainty that the 401k or the IRA is the right tool for you to be saving the majority of your money to make sure you minimize your taxes over the course of your lifetime? So this is where the third step comes in, right? With a tax advisor or creating an actual tax plan, right? And I always tell folks, you know, the tax code is longer than the complete works of Shakespeare. I think the complete works of Shakespeare take like 14 feet on a desk or a table, and tax code's like 17 feet long or something like that, right? But it's unbelievably complicated. And I always tell folks you can learn and try and do your very best, and it's great that you're at a class like this or listening to something like this, and you know, we're going to talk about you know, some strategies here, but it's very, very, very difficult to do without somebody or without asking some questions. I'm going to do my best to impart some wisdom to you here tonight that I've learned over the years, and I'm going to try and help you kind of understand what a more proactive plan does for you and how that might be you know, something that can help you and your family keep more money in your pockets. All right, so let's just start at zero, right? Let's just start at 101 here for taxes. So there's 5 different types of ways that people can file. Single, married filing joint, married filing separate, head of household, got to be a little careful with that one, or a qualifying widow or with a dependent child. Here's the thing to know about this. Your married status is determined on the last day of the previous year. Right, so if you're doing your taxes this year and you're filing them on April 15th, your marriage status is determined by December 31st of the previous year. Right, now we're going to dive into this. I'm not going to dwell too much on like what each one of these does, because most of us don't run out and get married to change our tax filing status. Right, if you're single, you're not running out and getting married just to change this. All right, so we're not going to dwell on this too much, but I'm going to come back to this and we're going to get a feel for it. All right. So let's talk federal income tax rates. These are the different tax rates, and I'm actually going to kind of back out here a second. Let's see what we have going on. Okay, yeah, so we'll talk tax mistakes, then we'll start talking tax planning. Okay, so your federal income tax rate. So the way that this works is we have a marginal system in our country, which means, let's take a single taxpayer, for instance. a single taxpayer in this 8,700 to 35,350 range, they pay an $870 tax just for getting to 8,700. They only pay the 15% tax on the difference between 8,700 and 35,000. A married taxpayer over here, for instance, they get to $35,350. They pay $4,867 of taxes just for getting to that 35,000, and then 25% of everything between 35,000 and 71,000. All right, I'm going to pull in the updated tax codes in a second. Just wanted to explain to you how the marginal tax rates work. So here's some of the most common tax mistakes that people make. Not reporting all income is a big one. I like to dwell on that one and settling on that for two reasons. One, not reporting all income is obviously fraud. Okay, and this is really common, especially in cash industries. But the other issue is that by not reporting all income, we're actually doing things that can lower our Social Security benefits in the future. This is also an issue with small business owners or families who get too aggressive with deductions, because we can actually lose out on Social Security dollars in the future when we may need them. Now, whether or not that's a good thing for you, whether or not that fits in your tax plan, we have to be able to quantify. Is there a reason to be aggressive with deductions and make sure you're paying as little taxes as possible? Hard to argue against it, but can we quantify it? All right, can we quantify that you're legally doing everything you can to keep your taxes low? All right. So now, as you're investing money, there's something called non-qualified money. All right. So non-qualified money would be like a brokerage account, right? That you have investments, stocks, mutual funds, whatever that might be. That can actually kick off interest income to you that you have to pay taxes on. Now, is that a good thing or a bad thing? Well, let's just take an example. Let's say you have an account that earns $10,000 in interest this year, a CD, right? You can use that in a non-qualified, non-tax deferred account, and that $10,000 of interest, you'll have to claim on your tax return. Now, if you're in the 22% tax bracket, you may pay $2,200 of taxes on that $10,000 of interest, effectively lowering your tax rate. One of the tools that's available to people is something that's called tax deferral, which allows people to earn interest on money they otherwise would have paid out in taxes. So there are accounts where if you earn that same $10,000 in taxes, you earn that same $10,000 in interest, the taxes there are in deferral, meaning that you don't have to pay taxes on them until you take the money out, and you get to choose when to do that. Now, when would you take it out? Well, you might take it out if tax is lowered, all right, or if you found some type of if you had some type of offsetting deduction or something like that. But basically, it puts you in the driver's seat to decide when to pay those taxes. The big thing for that is tax deferral often allows people to earn what's the word I'm looking for here? Interest, compounding interest on money that they otherwise would pay in taxes. Rental properties can kick off some taxes, long-term and short-term capital gains. All right, so let's settle in on that real quick. This is something that I hear that people are occasionally confused about. And this is something that we really want to talk about right now because long-term capital gains tax rates may be changing drastically. What a long-term capital gain rate is it's if you bought Apple stock 1 year ago and you waited the full 12 calendar months until you sold that. When you sell it, you pay it at the long-term capital gains rate, which is 15% or maybe 20% depending on your amount of income. So let's say you made $1,000 on Apple stock, you would owe $150 or maybe $200 in capital gains on when you went to sell that after a year. Now that's different than short-term capital gains. If you sell something in the first year, within the first 12 months of owning it, you actually owe income tax on it, right? Which can be quite a bit higher than that 15 or 20%. So it's important to understand as you're investing and changing things, are you paying long-term capital gains, short-term capital gains? Additionally, if you're somebody who owns mutual funds and some other tool or other tools inside of a brokerage account or a portfolio of some type, and somebody's managing that money, and making changes inside those, you may actually owe short-term or long-term capital gains on assets you didn't sell yourself, but the mutual fund manager or the money manager sold inside that account, and you may not even realize it. This can be a real shock to people because sometimes their account will have actually lost money, but because there's been sales inside that account, they may actually end up owing taxes on an account which lost money over the course of a year. Okay, and then there's ordinary interest and dividend income. Most of us probably see that kicked off. There's alternative minimum tax. I'm not going to dwell on that too much because I want to get to some stuff where we're talking about, kind of what tax rates are going to do in the future and how these things are going to affect IRAs, 401ks, and so on and so forth. So here's the interesting thing. This list right here of itemized deductions that most people claim. We are not going to dwell on this long because right now, the standard deduction for most people, single or married, is higher than an itemized deduction. So when you file your taxes, you can either claim the standard deduction, which right now is over $24,000 for a married couple, or you can itemize your deductions and claim all that. The vast majority of people right now are using standardized deductions. If you're using itemized deductions, you don't need me to run through this list right now because you already are deducting all of that above and beyond what you would use in the standardized deduction. All right. Now, let's get to the nitty gritty of this and let's really talk turkey. In the last year, the government has spent has spent the equivalency of the cost of World War II on COVID relief. So, does anybody think taxes are going down? I mean, I haven't I've asked that question a ton, and most people say, "Oh no, wait, taxes are going up big time," and I think that's correct. We can actually see that for over 40 years after World War II was over, the tax bracket stayed super high, right? In the 2000 to 2010s, tax brackets were in the top tax bracket was 39.6%, which is where it is right now. It's actually 37% right now. So taxes are drastically lower. In World War II, the top tax bracket was over 92%. And it's been higher than that for almost the history of the last 60 years, 60, 70, 80 years. So right now, you want to kill a party, walk in when somebody's complaining about the taxes, show them this chart and say, actually taxes are low compared to where they have been in the past. Now, we know taxes are going to increase. President Biden and Congress has saber-rattled a lot about this. They're talking about that. They may change the capital gains tax rate. There's been talk about even wanting to take that up to 37%. And I don't know that they're going to do that. They talk about changing the income tax brackets, raising taxes. Well, we already knew they were going to do that in the future anyway. All right, so 2026 filing or the 2025 tax year, taxes are set to return to the 2017 levels. I'll talk to you about that in just a second. I'm going to pull up another chart and we'll kind of talk about exactly what that looks like. But the question I have for you right here is, if tax rates are going to increase in the future, what does that tell us about what we should be doing now? I'll draw a comparison. Let's say I go into a department store. I'm looking for a new coat, and I walk up, and the salesperson comes over and goes, "Oh yeah, sir, that's a fine coat there. If you're and the good news is that coat's 30%, 30% down right now. It's 30% marked down. And I'm sorry to tell you this, but next week the sale's ending, and that coat will go back to full price. Okay. Well, you best believe I'm going to buy that coat when it's on sale rather than wait a week and pay the higher price. This is what the IRS has basically done. We've been told that the tax code is going to change and increase in the future, and that it's low now. So what opportunity does that give us? Is it the same type of opportunity as buying that coat? I think it is, right? I think it is. So let's take a deeper dive on this, okay? So what we're really asking is, should we pay taxes now versus paying taxes later in the future? All right, I'm going to share my screen. I'm going to share a different screen with you here. Bear with me real quick. Right here, this is what I want to share. All right, and so this is just a very simple Excel calculator that we use to track different things. So right here, we have the 2020 federal income tax rate. Just haven't updated this because it hasn't changed that much, but it'll serve our purposes tonight. All right, so let's go to married filing jointly. So right now, where are taxes at? What's going to happen with them? Where are they going to go? Let's dive into this and figure it out. Okay, so right now, if you are making $326,000, you're in the 24% tax bracket. In 2026, the 2025 filing, or 2025 tax year, 2026 filing, the taxes you have to turn in on April 15th, 2026. I'm sorry if that's confusing. That same person making $326,000 would be up in the 33% tax bracket. But take a look at this. Somebody making $75,000 would be in the 25% tax bracket. So what I want to show you here is you can make 4 times the amount of money right now and be in a tax bracket that is 1% lower than somebody making $75,000 based on the 2017 levels, which is where we're going to return to. Even if Congress and President Biden don't pass the tax code changes that they want to, we are returning to this tax code in the future. Taxes are increasing in 5 short years. 3 short years, 4 short years. My goodness, what year is it? Oh yeah, it's 2022. Okay, so taxes are going to increase. So what this tells us is that there's a real opportunity here to potentially do some tax planning if you can and what does that tax planning look like? Well, what it looks like is quantifying what your income is currently versus what it will be in the future. And if in the future your income is going to be in a higher tax bracket than it is now, you may want to consider doing some conversions from IRAs to Roth IRAs. Now, don't everybody run out and do that. I'm painting with a broad brush. I'm not giving tax advice right now. Okay? I'm just telling you what you may want to consider. We don't have enough time here to be able to do all the different scenarios. And by the way, everybody's financial life looks so different that it's impossible to talk about all the different scenarios. So don't run out and go, oh man, this guy said I have to put everything into Roth IRAs or I have to convert all my money. I don't know because I don't know your situation. I do know it's important to quantify that, whether or not that's a good idea. But the thought process that you may want to do is you may want to say, hey, if my taxable income is going to be higher in the future than it is now, I may want to stop deferring some of the money that I'm deferring into 401ks or IRAs now and maybe use some Roth IRAs or some other type of tax shelter. All right. I don't know if that's good for everybody, but it's something that you may want to consider. Now, how can you quantify that? All right, let's walk through a little bit of a scenario. Okay, we'll try and kind of figure out a scenario that's going to help us understand what's going to happen. So let's say there's a couple right now, and they're making, let's just say $150,000 a year. Okay, so $150,000 puts them right now in the 22% tax bracket. All right, they get a $24,600 deduction, standardized deduction. So, you know, they're really paying taxes on, $126,000 of income. Okay, so this couple has been doing everything right? They're in let's say they're in their late 50s or early 60s, whatever it might be, and they've got $1.2 million inside their 401ks or IRAs. Okay, and they're thinking to themselves, great, we're going to retire and we're going to live on our Social Security and pension income, right? And it's going to cut approximately in half. So we're going to have $75,000 in income once we get to retirement, and that should feel pretty good for us. Okay, so they get to 60, they 62, whatever it might be. They've got $75,000 coming in, and they look at their IRA and 401k and say, I don't necessarily want or need more money from this. So what I'm going to do is I'm going to let it sit, and maybe it'll earn 5% rate of return, might earn more, might earn less. Just want to understand what's going to happen. So now this 62-year-old couple, they have 10 years to go until they have to take a required minimum distribution. So when we are quantifying future income, it's important to know things like Social Security income, pension income, required minimum distribution income, farm income, rental income, income from a job or a part-time job, or whatever it might be. Where are the interest income, dividend income, so on and so forth? Where are all these streams of income that are reportable to the IRS going to come from, and how much is that going to be? All right, so this folks example, we're just being very, very conservative here. We're saying they have $75,000 coming in, okay, a year from Social Security and pensions. So they say, well, that's enough for us to live on. Our house is paid off, so on and so forth. We're just going to let our $1.2 million earn 5% per year for the next 10 years. So this is going to grow to approximately $2 million over the course of 10 years. And then what's going to happen is the IRS is going to come to them when they turn 72 and say, hey, you have to take an RMD. That's about 4%. It's actually a little bit less than that, but we're just going to round up. The government says, hey, that's $80,000 of taxable income. That's an RMD that you have to take every single year. So now this couple who during their working life was making $150,000 a year, now they're 72 years old and they're making $155,000 a year. So right now at $150,000, they are making, their tax bracket is in the 22%. Now they're retired, and guess what? They can no longer defer money into 401ks or IRAs to keep their taxes low. Their kids are gone, so they don't have child tax credits. Their house is paid off, so they don't have mortgage deductions. And the government raises taxes. So the government comes to them and says, hey, you're making $155,000. You're now in the 28% tax bracket. So the issue that we can run into here with this is these people deferred money into 401ks or IRAs at a lower tax bracket than when they take it out. If you defer money into a 401k or IRA at the 22% tax bracket, you can defer $10,000 into that thing, and it will save you $2,200, right? And that feels good because we don't have to pay it for taxes. But let's say you're 55 years old or 65 years, let's say you're 55 years old, you retire at 65, you go, you know what? I'm going to take out my $10,000 and I'm going to take out the interest earned too. Well, that would be $16,200. And now the government comes along and says, hey, we've raised taxes, by the way. It's no longer, the 22% tax bracket. You save $2,200. You're now in the 28% tax bracket. You owe us $4,558. So what we did was we made a deal with the government to save $2,200 for the right to pay $4,500 in the future. Now, don't everybody panic. This happens all the time. Don't panic and run out and change everything that you're doing. If you have additional questions on this, feel free to email me, info@ifeonline.org. And if this is going on, I can kind of run these calculators and help you. One of the things as part of our nonprofit organization, one of the things that we do is we tell people, hey, if you want to take 20 or 30 minutes on the phone with us, ask some questions and have us run some calculations for you, we're happy to do it. Okay, do it for free. We don't mind doing that to help people in the community. But if you have those questions, just let me know. info@ifeonline.org is my email. Okay, you can go to our website, ifeonline.org as well. All right, or so this is a serious issue. Now, the one other issue I want to touch base on with this is what happens long term with taxes when you pass away. Okay, so let's go back to our example. This other couple, they have $2 million in their IRA when they turn 72. They have to take out $80,000 a year. Now, here's a big disclaimer for you. I don't know if they're going to earn 5%. They might earn 4. They might earn 3. They might earn -1. They might earn 12. I don't know if they're going to take out $80,000. They may take out more as time goes by, or they can take out less. Actually, they won't be able to take out less. They have to take out at least their RMD, which does go up a little bit each year. Okay, my calculator here doesn't show that, but I just want to understand the scenario here. I want to understand the philosophy behind what's happening. I don't care to dial in on the dimes and nickels right now in this situation. We just want to talk taxes and what the IRS is going to do. So these people start taking out $80,000. They earn 5% a year for another 10 years, and at age 82, they get in a car crash and die. All right, so they have $2.2 million left over in this 401k. What's going to happen to that money? Let's say they have, I don't know, 3 kids. All right, so each kid is going to get about $700,000. Well, what happens is that becomes taxable as income to the kids if they take it all in that year. Now, the Secure Act changed things up. They can take it out slowly over a 10-year period of time, or they can wait 10 years and take it all out, or they can take it all out at once. The vast majority of people just take it all out at once. Very few people kind of stretch it out. So I'm just going to deal with that scenario. Okay. If you have questions on the other scenario, just let me know and I can answer them. But what's going to happen is the government's going to go, okay, your kids, whether they're married, filing single, married jointly, filing jointly, single people, whatever, it doesn't matter. It's going to launch them in the top tax bracket. It's 39.6%. So now what's going to happen to your $2.2 million is about 40% of it goes away to the IRS, $880,000, so $900,000. So there's $1.2 million left over. So each of the kids ends up getting $400,000 and the IRS gets $880,000. It's a terrible scenario. Okay, it's a terrible scenario. And I can tell you right now that these IRAs are the least efficient estate planning tool that's ever existed because of the level of taxation that kids experience on them when they inherit them. All right. All that means to you, to me, to anybody else is that we really need to be able to quantify when we partner with the government with these tools, whether or not it's the very best thing for us. I wish I could dwell on this more and run down through all the scenarios, but all of your financial lives are different. There may be scenarios where putting money into 401ks and IRAs is absolutely a positive. But we got to be able to quantify it. We got to be able to know. We can't be doing it just because our manager told us to do it when we joined the company 25 years ago. We can't be doing it just because our uncle, the plumber, who may be a great guy and a great plumber, which is a great profession. We all need plumbers really badly. And he may be a smart guy too, but he may not know everything there is to know about IRAs and 401ks. What we need to be able to do is, rather than relying on folk wisdom and other people's advice, we need to be able to quantify if we are going to have the maximum amount of value and wealth from our money due to our tax plan during the course of our lifetime. All right. So let's just head back to our here we go. All right. So, whether or not you pay taxes now or do tax sheltering, most folks right now are really interested in doing some tax sheltering. If you have questions on that or want us to quantify that for you, we can absolutely help. Okay. So, there's all these different types of retirement accounts. I went into it really well a minute ago when I was talking about how $10,000 could save you $2,200. And, there's all these different types of retirement accounts that exist. The big difference is Roth TSPs or Roth 401ks or Roth IRAs allow you to defer money into a tool that will allow you to take it out tax-free in the future and pass it on tax-free to your kids. Those are two really powerful benefits. I want to know if they work for me or if there's something I should be using. All right, so let's talk a little bit about tax planning for the estate, and then we'll kind of start wrapping stuff up. So here's what's going on right now with tax planning for your estate. We just covered the most important thing, which is the permanent income tax on IRAs, because that's the one that affects all of us. If you have $50,000 in an IRA or $50 million in an IRA, there is going to be a massive tax on it when you pass away. Now, I want to talk real quick about inheritance tax and estate tax. Inheritance tax and estate tax right now, you can pass on $12 million to your kids without any type of estate tax. This is the death tax I'm talking about. Okay, here's the problem. That number is going to move. It'll change at some point in the future. I don't know when. I really thought it was going to happen this year before November came around and there are midterm elections, but it looks like Congress and President Biden are having a hard time getting on the same page with passing legislation. That doesn't mean it won't happen. Just from the outside looking in, it doesn't look like they're getting a lot done right now. So I'm not sure we'll see a change in any of the stuff that we're talking about. I thought for sure it was going to happen, but it's just not happening for them. So it might yet. Okay, not making a political comment, just observing. But what happens is this estate tax has been as low as $600,000 in the past. Use a scenario: if the estate tax is $12 million and you die with $1 million, you owe no estate tax. The government doesn't get any of that other than what might be in an IRA or 401k. Okay. If the estate tax exemption is set $600,000 and you die with $1 million, the IRS taxes the $400,000 above the $600,000 exemption at whatever rate it is, 35, 45, 55, it's been as high as 55% in the past. So that means is that your estate is going to be out hundreds of thousands of dollars. Now, why do I want to bring this up? This number is in all likelihood going to lower. And there are tools that you can use to double your estate tax exemption so that the IRS gets less money. I'm not going to talk about this ad nauseum. I'm just going to say if you're somebody who is a high net worth individual, $5, $6, $7 million or more, you may want to look into this and learn quite a bit more about it because any changes could impact you. Last year, only like 1,500 estates in the entire country got charged an estate tax because most people with that kind of wealth had doubled their estate tax exemption to over $20 million, and they use some other tools to, lower their estate taxes as well. But if you are somebody who's a higher net worth, you may want to talk about, exactly what's going on with this. Okay, so just to kind of give you an idea of what the foundation does, and when we talk with people, if you have questions on Social Security analysis, retirement income analysis, tax-free income, planning for highly appreciated assets, if you want to reduce taxes or eliminate them on sales of stocks, bonds, if you have questions on estate planning, or you want to retire more quickly, or you want to exit, from your business if you're a small business owner, or if you don't know what you're paying for portfolio management fees and you want to learn about that and maybe eliminate or reduce them, or the way people are doing that, or if you want to plan for tax efficiency and retirement, these are all things that we're able to help folks with. How do you do that? You can contact me, info@ifeonline.org. That's info@ifeonline.org. I'll be more than happy to sit down with you for a half an hour or 40 minutes or so and just chat about your situation, help you kind of understand what's going on. We do that for free. There's no obligation. And, we're happy to kind of help families get pointed through in the right direction. All right. Folks, I can tell you, you deserve more, you deserve better. This is your financial life. It's going to be what you make it. The education that you're receiving here and the time that we spend sitting down and chatting has been, from my experience and from what people have told me, some of the most impactful time that people have ever spent on their finances. So if you have questions, please feel free to reach out to me. One of our volunteers will be happy to chat with you. We have 4 people, myself included, who, kind of follow up with people and answer questions when people have them. So that's kind of everything I had for tonight. If anybody has any questions, I'll kind of be happy to take them. But otherwise, I'll just let folks follow up with me in the future. If anybody needs anything, just let me know. Otherwise, I'll look forward to getting to meet with the Champaign Public Library and being able to do these, and hopefully we'll be able to do them in person soon. And I know that'll be really fun for all of us. So that being said, I'll wish everyone a good night.
Thank you, Tyler, for the informative and helpful presentation. And thank you all for your attendance tonight. A recording of this event and many of our previous library webinars could be found on the library's YouTube channel. Due to COVID-19 restriction, our next series on February 17 will be virtual webinar on 5 secrets of saving for college from Bluestone Financial Advisor. Be sure to register for the webinar on the library's online event calendar. We hope to see you there. Good night, everyone. Thank you.